So tonight we're going to talk about certain things that one must be reminded over and over in the trading world, right? I mean, sometimes we work, we do certain things, even if you're doing business, right? Or if you're in a hedge fund, they have all this special team, just to get you prepared every week, or maybe every day, or maybe every few months. It depends on your mental capacity, and or sometimes you have a great week, how not to mess up that great week that you had, or if you had a bad week, you know, how to bring the confidence back in that, hey, it's okay, it's part of the market, it happens. Personally, I last year I had a lot of bad weeks, but I also had a lot of great weeks, right? The year wasn't as strong as I thought it would be for me, but it's okay. Sometimes, the best way for me to put this is, you are, as a trader, you yourself, you are one chart yourself, right? You're a chart yourself. Now you see what kind of chart do you want to be? Do you want to be Apple long term, like keep running? Do you want to be Amazon consolidating for some time? Do you want to be Jumia, make so much money in the account, then give it all back up? Do you want to be Tilray, make so much money, give it back, and then another spike, and then give it all back? You yourself as a trader, you're a chart yourself. Now you see how you want to chart your trading, right? And it all depends on you. If you're a high risk taker, then your chart will be very volatile. You'll get, you'll be a VIX, right? I mean, to put it in a way. So all these things. Now tonight, some things that we're going to talk about. One is managing. I think that is very important, right? Managing the account. So I'll spend some time on that, right? And then I'll spend some time on Strangles. Lately, a lot of I still have some DMs which I need to respond to on Strangles, where you guys are asking me that, is this a good strangle? And if I say, if I give you my opinion, then you're like, oh, how about this? Is this a good strangle? Then it just feels like that you're throwing some calls, puts at me without even properly doing your DD, right? Some of them are great, some not. And I'm going to go over Strangles. When exactly is the great time to play them? They cannot be played anytime, all the time, right? I mean, there has to be a time to play them. And so first, let's look at the futures, right? We're opening green. We have, so NASDAQ, S&P, LB, I think he's going to go over these things later on with you guys. Right, and come in, and so we have NASDAQ right now. We're opening red. One could argue that we're on a very strong support. One can argue that we're we're bounced here, or one can argue this is bearish if we go on the weekly, that we're about to break down here, right? Now with the FOMC that we had on January 7th, the minute we had, it wasn't good. This pattern right here, the last 4 weeks, we had a bullish engulfing, then we had a bearish engulfing, then another bullish engulfing. But the last week, the bearish engulfing that we had, it just took out like a powerful move that, screw you, bulls. There's something needs to be corrected here. So now you want to be careful, first of all, what to do here. And are you still a bull, or do you think that some downside will come? Personally, a lot of charts are broken. Some have absolutely crashed. What happens now, right? This part I'll leave for LB. So love your listening. He'll go over some patterns with you, maybe on TradingView, however he wants to do it. And then, so I'll leave that part for him. Personally, number one, that thing I think is very important is managing the account, right? Managing. Now, this is another skill on its own. Sometimes I myself have trouble with this. I promise you guys, right? I talk about this. I teach this a lot to people, right? But sometimes me, myself, I have a lot of trouble with this myself, right? And because human nature, right? I'm not a robot myself. I also have emotions. So sometimes I fall prey to my own self. Now, number one, managing, first thing that you need to ask yourself, what is your account size, right? Your account size, okay? Your account size. Now, is it $5,000? Is it $10,000? Is it $25,000? Is it $100,000? Is it $150,000? Or is it $500,000? Now, each of these monetarily values that we have, I think somebody's on video on the right. I'm not sure who you are, but you can take your camera off if you'd like. You're wearing, I think you're in the hospital, looks like. Okay. Never mind. But so each of these account sizes will have a different way of trading. And then and you yourself as a trader, are you really good at options, weeklies, dailies? Are you good at spreads? Are you an equity trader? Are you like a seasonal trader? You buy something for 3 months, let the ride out, or are you a fundamental trader? It all depends, right? Now here, I'm assuming that most of you guys trade options, right? If you don't, that's fine. We trade equities as well, right? So that's fine. Now, on a $5,000 account, if you have a $5,000 account, number one key is your position sizing. How big will your position sizing be, right? And what kind of stocks should you play? on options, right? A $5,000 account should not even look at stocks like Amazon or Google. Avoid these stocks because one good option to play on Amazon, Google costs minimum of $10. If you're buying an option on Amazon and Google for less than $10, that means you're either doing a weekly on a Thursday, right, when the options are cheap, right, or maybe Friday morning. But again, you're going to be taking a risk on Friday morning. If you're playing an option which costs $1 or $2, if Amazon does not move for 10 minutes, that option will be cut down in 50% right away. So number one thing that comes here, what kind of, so I'll just write down here. You know what, here, I'll do this, so it's easier. I'll merge all these. And here I'll have my font bigger so you guys can read. Here, number one thing comes is which tickers are to be played, right? Are to be played here. So here, what you want to see is tickers, I would say under $300, right? Here, so under $300, here. So tickers under $300, right? Why? Because options will be affordable and reasonable. What do I mean by when I say reasonable, right? What do I mean by when I say reasonable? Amazon, a $5,000 account buying an Amazon option, it is not reasonable. All right, you might be able to afford the $1-2 option, but now that you're buying Amazon in this $5,000 account, is it really worth it? Unless Amazon runs 100 points in your direction, yes, you'll be able to sell that for 5, 10, 20, 30, whatever it may be. You don't need to play Amazon if you have a $5,000 account, right? We do a lot of other stocks like SC. SC, we're very good. LB is usually always paying SC. Great. MasterCard, Visa, Apple. You name it. There are a lot of tickers that are under playable for $500, 5,000. Okay, so number one thing is which tickers are to be played. That's one thing you guys need to understand. Amazon, if your account is not over $25,000, take Amazon off your list. One good hit on Amazon, if you have a $10,000 account and you play most of the options that I personally take on Amazon when I play calls alone, they're $20, $40, sometimes even $150, which is $15,000 per contract, right? LB's lottos on Amazon are $10 per contract. That's $1,000 as a contract, right? Not advisable for this count size. All right. So number one, you guys can make these notes, write them down. If you have a book, please, right? I personally still take notes until today. Which tickers do you want to play? All right. Here you want to play tickers under $300, close to $100, 150, 50. I mean, there's many tickers that we play. That's number one. Next comes position sizing. If this account is only for trading options, $5,000, you want to grow this account. Position sizing comes into play next. On a $5,000 account, if you're doing options trading, I would humbly request, never go in more than $150 to $200 per position. All right. Never go with more than $150 to $200. All right, per position. Okay. $150 to $200 per position. All right. Now let's say this position goes to zero. And guys, I'm just gonna talk more here, not do the math, so you guys can understand. If you're going with $150, $200 per position, it gives you at least minimum 25 plays. Now, I'm not saying that you're going to go to zero from 5,000, but let's say if this does not work, if this option does not work, you still have $4,800 left in your account, and you can, you will sleep peacefully at night because you took a reasonable hit, which is fine. It's very easy to grow. Let's say your next position also goes to zero. All right, now you're left with $4,600. All right, you're still happy. You know why? Because let's say you lose two, but if you're a trader that does his work, you're a trader that puts in work, you're not going to lose every trade. Your winning trades will eventually outlast your losers. Next trade, let's say you hit a 300%, for example. Okay, 300. Let's say it happens. Now you're up 600. All right, from another 200, you add a $400 up plus, right? 400. So now you're back to $5,000 where you started. Hey, you know what? You're holding the account. You're building up your chart. You're in this phase, maybe right here. You're building up your chart. Let's go on the chart, for example, RBL, just an example. So this is one IPO that was going up, I think, for example, something like this, maybe. Okay, you're starting here, and then all of a sudden, you kept your base strong. You did not start dipping. You did your due diligence. You kept your base strong, right? Next trade, let's say you maybe hit a 50%, right? Now on $100 plus on top of a $20 trade. Hey, you know what? You're up in profits, and slowly this compounding effect will kick in, and so on. Like you will be a nice little ride upwards, sometimes with a big dip. Yes, sometimes a losing week, a losing month happens, right? But what I mean to say is overall nicely you will be up. All right. Or if I go in Apple here recently, for example, your account may look something like this: a consolidation on the left, up, down, something you break out, then you consolidate more, go up, and then maybe take some few hits, you consolidate. Overall, as long as there's growth in the account, that's what I'm trying to say. But that is going to come if your position sizing is consistent. Now, if you hit 3 trades, let's say you hit 3 trades, Dr. Love throws out a trade, Teeth throws out a trade, Yash throws out a trade, Ginger throws out some puts out there, Takas gives out a voice chat play, or Preston comes up with something, or anyone else, one of our regular traders, could be any one of our admins, anyone that throws in something, you nail it. All of a sudden, you decide, let's say your account's at $5,500, you were doing the $200 trade, you're in a nice growth. All of a sudden, you think, you know what? I want to go with $400. It's okay. If I go with 400, I still have, I'm still up in profit. I'm using my profit. Boy, guys, I'm going to tell you right now, if you think like this, and if you're listening, I know some of you guys might be thinking like this, it is very dangerous. This one loser is going to take you right back to 5,100, back to break even, if you go out of your size. And even if you hit this 400 to 800, even if you take your account to 6,000, you know what you're going to do? I can promise you now, forget 400, you're going to go in with 1,000. And this 1,000 you're going to lose, and you're going to go right back to $5,000. Ask yourself how many times this has happened to you. What's the need for this to happen? What's this greediness? Why do you need this? You don't need it, trust me. All right. If you keep your position sizing consistent, from the day, let's say now that your account has grown to $7,000, for example, you know what? Maybe I'll go up 250 now. Okay, I will go up 250 per position, and then eventually one day your account will hit 10,000, and now maybe you can move on to $300 per position. All right, and guys, this rule applies to all these monetary values here. All right, now 3,000, and then eventually your account will hit 11,000. Let's say 15,000. You can stick to 300 because $300 is still a reasonable size for 15K account. Maybe you can go to 400, right? Maybe you can go to 400. Notice from 5,000 to 10,000, I did not go 400, right? I still kept my positions all smaller. Why? Because the gains get bigger now. You have to understand this. Your gains percentage on a $300 are more than 200. Your gains, you're up 50%. Remember that, okay? So there are different ways to look at it, okay? And then if you have a 25K account, maybe you can go in with $500 per trade. Right? Some of you guys, if you're asking yourself, how come he's doing $200 per trade here on a 5K account? Shouldn't it be $1,000 per trade here? Yes, you can go per 1,000, but the question here is sometimes money matters, right? On a $25,000 account, if you're going with 500, you can hold trades for longer. You can let them play out a little bit longer, okay? You can scale out instead of buying 1-2 contracts here or maybe 5 contracts here. Here, you might be getting 20 contracts where you can let your winners run for a little bit. You understand, the bigger the account, the more comfortable you will be letting your winners run, which in turn return high percentages. If you take a 5K account to $2,500, for example, if you take a $5,000 account to $2,500, I'm going to talk psychology here also a little bit. If you take this account to $2,500, you know what? You still might be okay mentally. But if a person takes a 25K account to 12,500, this guy right here, mentally, he will be more unstable, because he's lost a big chunk of the 25K account. $12,000 is a lot of money. $2,500 is still not a lot of money. All right. Maybe you both have the same job, same income, but because he took a bigger hit, now mentally he is more unstable. This is why you keep your position sizing according to your size, and then in options, because the money returns are high, then you can. Is this making sense, guys? This little part that I just spoke about is very important. And a 100K account maybe can do $1,000 per trade. All right. Is this making sense? So this is very important for you guys to understand. And if a 100K account guys takes his account to 70K, I'm telling you, this guy will be stressed. He will keep thinking a 30K loss. You know why? Because he may not have managed, or maybe he took some big sizes sometimes, and this happens. Me, I start a lot of accounts with 100K sometimes, right, throughout the year, because I like doing it. And with that, what happens is sometimes, yes, I do end up going to 70K. I'm not going to lie to you. It happens. I'm a trader. And then the pressure here is so much more. Why? Now I have to earn almost 50% on top of 70,000 just to get back to break even. All right, just to get back to 100K, the pressure is much higher. But if I take a 5K account to 2,500, I usually don't even care. It happens all the time, right? Because it's not monetarily, it's whatever. I don't care. Right? I can just deposit maybe another 2,500. Just an example. All right. So that's how you have to think of it. right? In fact, one of the accounts that I have right now, it's a six-figure account, and it's actually down about 25%. I'm very transparent though, guys, when it comes. I'm not always making money. Okay, I will be very honest with you guys. Sometimes, yes, I do take hits, but you know what? It's part of the trading world. As long as in the long run, I'm in the uptrend, I'm fine. Okay, and because I'm a regular trader, so I'm very confident. For me, it's not the first time. For LB, he might have been in that position. I don't know. For T, he's been in it many times myself, right? So it's okay. I'm used to it. Like it happens, but I know I've been there many times on that path. I know exactly how to take the 70K back to maybe 150K now. Like I know I've been through the process. All right. But if you haven't with these smaller accounts, then always, please manage your size. It is very important. So position sizing, I cannot stress enough about. All right. So that was a little piece on position sizing, and please do let me know in the chat if there's anything else that you guys need covered based on this. All right. And another thing here now is your date of expiry on the options. All right, date of expiry. Now, if you're in this trade right here, in a 5K account, you want to go at least maybe 2 to 3 weeks out minimum, right? If you're playing small tickers, the reason being is those options sometimes move slow. On this count, what you can do here is on a 5K account, 2 to 3 weeks out minimum. If you don't have a 25K account, avoid weeklies. Okay, avoid weeklies on a 10K and a 5K account. I would highly recommend. Unless you made $1,000 profits, you want to throw $100 into weeklies, yes, that's fine. Here, I will simply say avoid weeklies. Weeklies limited, right? Limited. And here, yes, you can take some weeklies if it's a bigger account, right? I mean, you can take $500 per bet, I think. Another thing that I do want to add to this, right, is on a 5K account, please try staying at least 85% cash at all times. At all times, if you're an options trader, you will sleep peacefully. Even if your position goes to zero, that's fine. You will at least sleep peacefully with 85% cash. Same thing goes for 10K, right? For a 25K account, I would say the same thing. If you have a 100K account, I will say at least minimum 75% cash at all times. Now the question is, where is the 15% cash allocated, right? Where does the 15% cash go? From here, I would say maybe 5% in 2-3 weeks out, okay? Maybe 5% 2 months, and maybe 5% in leaps, all right? So I mean, these things as a trader, I mean, trading is not just hitting buy and sell, guys. Trading involves math, I'm telling you guys. LB, let me know, bro, if you want to add it. And LB, you can unmute yourself if you want to add anything to this, right? Trading involves a lot of math, I'm telling you guys. If you're just trading without doing the math, if you're not looking at your account, last week, I was looking at my account, I was doing some math, and Baba, Alibaba, I actually been a little aggressive in it. Like, I mean, those of you guys that have been with me for 1 year, with us in my stock, like you guys know it, Alibaba, I went a little aggressive, and you know what? I had to take that hit. I had to just cope with it when it happens. I know it was another learning lesson for me myself, right? Here, your other 25% cash, if you have a 75% cash, then again, you would just divide up these levels, I would say, in 3 separate parts or something similar, whatever suits your style. All right. Is this part clear, guys? Does this make sense? You can also unmute yourself if you want to call, that's fine. Yeah.
Makes sense, Rickson.
Thank you. So that's that. Date of expiry. So this is very important when you guys are playing a thing. And number of positions I just went over, right? Avoid too many positions. Avoid. One thing I will give you guys, avoid too many positions. This goes for everything, all the account sizes. Avoid too many positions. Avoid FOMO. The second you have FOMO, get the heck out of the trade. Leave your chair, go for a walk, go get a drink of water. Come back. I promise you, 95% of the times, that trade is likely a loss. If you're having a FOMO trade, the market maker has caught you. He exactly wants you. He's going to suck you in and take away your money, and then you're going to be sitting there looking at the screens. The second you have FOMO, I'm telling you guys, leave your screen or change a ticker. Many of you guys, for example, if I was to go into Amazon right here, because we've been going into here, right? Many guys, how many people you think got caught on this? Do you guys have any idea how many people got caught up here of these candles? Do you guys have any idea how many people got caught off here? There were people who were sitting here for watching 5 minutes. They kept watching this. Oh, Amazon's gonna break out. Oh, Amazon's gonna break out. You know how many people got caught out on this breakout? How many people probably called this, right? And then boom, right down, right? So that's the one reason that, at my stock, like one thing that we always say that, what, let the levels be held. It's been almost, I think, ever since this date, which was 15th December, we've only been saying one thing on Amazon. We've been saying one thing. What is it? 3450 minimum hold. The reason being is, if you're trying to catch a bottom here, you can draw all the trend line patterns here. If this zone is not held, 3450, which is about 200 mA of 50 mA also, don't play it because there's weakness. The time it holds above here, you want to wait. See, they tried holding it here, but then there was a gap here. We did not get the move. We avoided long positions. I did play some strangles, made some profits. Then I bought some more strangles for this week. And because of this time decay, they are kind of down. But I think if we get the move Monday, if we get a flush by any chance, or 100-point move one way or the other, I think we'll nail profits on this. So that's the reason we always say hold, let the levels be held, and then you can play all you want. Okay, or else don't get caught in something like this. For example, SC, Roblox, or any of these, like, when they give you a dip, this dip is basically for them to sell more. Is for them to sell more, right? Any smart trader would simply wait here for a level to be held, to add. All right, you would wait for a level to be held, and this implies to all the charts. Here they tried, but a no hold, the hold did not happen here. Next day there was a gap, right? All the people that bought on this poke and then came here, next morning there was a gap, right? So personally, certain levels that we give you when we say hold, let them be held. Let them be held. Money will be made. All right. Twitter, for example, I bought leaps in here, which are currently down. But again, here, does this pattern play out? I don't know, but I'm just trying to say certain levels have to be held. This IPO price was not held. This is why I did not average down. Some people are messaging saying, are you averaging down on Twitter? Are you going to average down? Hell no. Why would I average down in this downtrend? A level has to be held. A new trend has to be formed, which can take maybe another month, 2 months, 3 months, and then I will look to average down, right? Jumia, for example, I wanted to average down. Well, why should I? It never held the levels. It never held above $12 or 13 for more than 1 or 2 days. It was never able to get above 50 DMA, right? So things like that. LRCX, for example, one number that I kept waiting was 729. Most of you guys know this. We kept waiting for it's not the 729. It's not, I don't have no magic number. It's just these resistance levels. That's what those numbers are. They're not numbers that I, take out of my, no, it's nothing like that. It's just, it's very simple. Anybody tells you they have a special number, anything like that, it's all bullshit. It's a resistance level number that you can also figure out. Here, it was simple. If you zoom into the 1 minute chart, 2 minutes, and plus I watched the level 2 a little bit, right? 729 plus was a hold. They were just selling. They kept selling. And you know what? Because it wasn't able to get the 729 hold, we avoided the lottos. We avoided the short-term play on it, right? Which we were absolutely right. However, the Jan position that I have is not good for LRCX, unfortunately, right? Bank of America, we nailed, right? Last week, another play, PLTR, for example, right? Which we nailed here. This play I especially called out. I said, hey, I have a very good strangle. The whole, and I am going to go over strangles here, guys. There's a time to play strangles. So if you're listening to this, so we're going to go over strangles right now, right? There's a time to play strangles. This is a perfect example, right? When the stock that moves, so I'm going to give you guys another tip here. Okay, let me give you guys some secrets here. There's a technical indicator called ATR. Does anybody know what ATR is? ATR, what it stands for? Anyone? Do you guys know? Anyone? Anyone? No one? Okay.
Average price range or something like that.
Yeah, average true range.
Average true range. ATR means average true range. So when playing strangles, and guys, there's nobody taught me this stuff. These are things that I learned on my own. So I'm telling you guys. So please don't share it with other people, because some people, as you guys know, have created stuff with their own free group, and all the things they learned from here that we teach you guys, that we put so much work into it, and then they start sharing it there, which is fine. But sometimes it's a matter of respect. Sometimes, right? You don't ever want to stab anyone in the back. But average true range, right here. Now this stock's range was, there's a weekly chart I'm looking at, was $5, and then it's just been going down, 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 down. What does that imply? That the volatility has decreased. Options are cheap, right? Here it's been down. It's almost $2.43 where the ATR is, and then I saw, PLTR has been sideways for a long time. It's been sideways for a long time. It's due for a big move, because it used to make big moves here. Now it's due for a big move. Most people in the market, I promise you, most people here would probably, no matter who you ask, they would probably tell you to go long PLTR. here they would probably tell you to go long PLTR. Personally, I was also leaning towards going long PLTR here, but then I said to myself, you know what, man, if this support breaks, right, the way they've been killing stocks, this thing can even see 12 or $10 very soon, right? Which happened with a lot of stocks, and we have to keep them in mind. So when this stock was sideways for 4 weeks, I said to myself, man, this is ready to go for a $2 move one way or the other. It's just ready. And PLTR, if the move happened to the upside, we would have made more money, obviously, because the delta was much higher, right? I lean more towards the calls. But even though we bought the puts and the calls together on this one big move, we were able to lock in profits of 25-30% on that play, right? And that play was a full size position for me. I bought my 100 quantity, which was roughly $14,000, and I locked in a few $1,000s off it. And because it was to a downside here, now I also have to exit at the right time, because if I don't exit and it goes back up, my puts, which went up more, would come back to break even, and the calls would come back to break even. My position would now be a break even position, or less because of time decay. So that's the reason I took my profits on PLTR. I'll let it set again for some time, and then we'll come back to it. All right. Amazon right here is another strangle play if your account can afford it. Why? Because it's been consolidating for so long. They're either going to drop this big now, and if they bounce this name, if they bounce it, then it's going to be back to a shit zone again, right? I mean, it's going to be back here again. All right. So, but now if we get the flush tomorrow under 3,200, then I should either I'll probably make good money on it, because then they're probably going to flush this much more lower with the market. All right. So you want to look at names that have been consolidating sometimes, and then they make a big directional move. All right. You can always draw charts. For example, Apple, for example, here, right? I'll just clear this. As soon as it makes a pattern, this pattern right here, right? As soon as it holds a range, and then you know that the stock's going to go out of the range soon, right? Or it's made this a pattern that something's going to happen here. You can play this to the upside or to the downside. So strangle, you can either play at a very strong resistance level, where if it breaks out, you make money. If it fails, it comes down and you make money on the put side. But don't get caught in the strangle in between here. All right. And if you're going to play something like Apple, always buy 2-3 weeks of time, give yourself time. A lot of options go 300, 400, 500% on Apple every week. All right. So these are the tickers you want to keep an eye out on. Right. Goldman Sachs is another ticker I'm looking at. Is stuck in this range. Now it's either going to break out soon, or it's either going to flush. So what you could do here simply is maybe a 2 months out. If you have a 25K account, 2 months out, I would probably buy one strangle, which should more than double. Right. I'll probably buy a 420 strike and probably a 380 put strike. All right. And then you can manage accordingly. Then another play that I have for strangles is where is it? Home Depot. Sorry, Home Depot and MasterCard. So Home Depot was a play that we were looking at. Is stuck in this range. This is another strangle play. You can easily buy 410 calls, or maybe 370 puts 3-4 weeks out. One of them likely doubles, right, on a one directional move. And you want to take your profits on time. If you don't take your profits on time, and then the stock bounces, then your price for those strangles goes down. All right. So strangles is very important. When do you play them? All right. If the move happens in one direction, then you can scale out of that play and then keep it. Another one thing I'm going to give you guys on strangles is a very important key part, a little tip if you're listening. If you're strangled, for example, if you bought the calls, right? Let's say if you bought the calls here, the calls are 50 cents, and you bought the puts, and the puts are also 50 cents. Obviously, you buy them. Your total cost is $1 here. Your total cost is $1. Now here you can close the strangle individually. You do not have to close it all at once. What you could do here is, let's say calls end up hitting $1.50, for example. These might be at a 0.10 or 0.15 depending on time limit. I don't know whatever they're trading at. You don't have to sell your puts. Why would you? You can hold on to all your puts. Just hold on to them. You can simply just sell all the calls, or you can scale out of the calls. Maybe scale out, sell some at $1, right? Or maybe sell most of your calls maybe at $1.50, whatever it is. So you lock in principal, right? Or I mean, you can sell all your calls. It depends how you want to do it. However you're comfortable with your thing. Right now, let's say the stock falls, these are going to go up in value. These go to, let's say, 30 cents, or even back to break even. You can sell these back at break even, right? Or you can sell the entire position together. That's up to you. But you can play around with strangles in such a way. One of these will go up initially, right? They just have to. And then if it goes more than 100%, you can sell some, scale out, however you want to do it for the one directional move. And if it approaches resistance, what you could, like, for example, here, let's say Apple, for example, since I have it, or Home Depot, I have it open. Let's say I played the strangle here, for example. Let's say if you bought the strangle here, right? It went up, What you could do here is your calls are, let's say they're over 100%. You can get rid of your calls maybe. And, we set a strong resistance point, lock in your principal and hold the puts alone. And your puts here will probably come back to value also. And then you can sell the puts individually. All right. So there's a lot of ways to play around with strangles, or you can simply just sell the entire position here. It's up to you. Okay. So just one thing for strangles, guys, there has to be a time when you want to play strangles, right? I mean, don't get stuck in a move like this where there's no move happening. All right. Stocks that are consolidating, those are the stocks you want to catch for strangles. For example, when Home Depot was here flat for 3 weeks, right? It was either going to fall or go up. You could have easily bought a strangle, right? And so these things. And if you guys have any questions, just type in, guys. All right.
I have a quick question. So while you're following all these charts, so are we following like a weekly chart, monthly, or daily chart? Means what is the best way to?
I follow the weekly. Like my recent one that for example, PLTR, I simply follow the weekly. 4 weeks it was consolidating, and I'm like, you know what, $2. It needs to go move $2 one way or the other, and that should be profits. So,
Okay, makes sense. Thank you.
Yeah. So that's why I,
Ricky, I have a quick question.
Yeah.
For newer traders, I know there's a lot of indicators that can be potentially confusing. I know that you've mentioned levels a couple of times, which is one of the most key ones for yourself that you mentioned, especially for newer traders.
Right.
What else would you say is sort of key, maybe top 2 or 3 that you would say newer traders should be mindful of?
Number 1 is 8 and 21 EMA. They're very accurate. I think LB follows 9 and 12, I believe, but these are just the ones that you need to follow yourself. And then you eventually, the more you follow them, the better it is. Right? The more you follow them, the better you get at it. And then you pick up the thing. When you start working on something, you don't get the handle at first time, but then as you're doing it, then you get used to it. 8 and 21 EMA, and then 50 and 200 MA. There's a difference between moving average and the exponential moving average. Just look up, you guys will understand. That's your additional homework. But these are the 4 I follow. 8 and 21 EMA on the dailies and the weeklies, then upward trend. If I go here, for example, so let's just go over this quickly. Let's go over here. I'll show you. Let's go on, for example, Twitter maybe. Right, and here this is the 50 and 200 MA, right? So here, what I'll do is I'll go on the EMS, which I like, right? And I'll show you something quickly. 8 and 21 EMA. So here, as you guys can see, the blue line is the 8 EMA, the red is 21. I can promise you one thing here, right? The day 8 here, let me now here it was consolidating, obviously. If a stock is gonna cross, a certain way, like here for a downtrend, when the 8 EMA took the 21 EMA down, and if the stock stays under, is likely gonna stay under the down pressure. See how it kept getting rejected? They kept it under, and then when it came back up, it got rejected by the 21 EMA. It got rejected. So the day 8 crosses over the 21 EMA now, right? It's oversold also. The day 8 and 21 EMA cross to the upside, they'll give us certain indicators. Twitter will probably see a $2 to $3 move to the upside, right? And you want to wait until that cross happens. Don't get stuck right here. Don't get see here when the cross happened. Even if you caught it here, you caught that $2 to $3 move. We're trading at the end of the day, right? You caught that $2 to $3 move. Now it's up to you how you manage a position. But then obviously you would manage. And then here it crossed down. It was just in consolidation phase, right? And then here more selling pressure, and then it crossed to a downside here. And then this candle clarified that, you know what, it's in a downtrend now. Fair? Makes sense? Or if I go on another chart, Apple, for example, see how it's been riding? This is even better than Twitter to show you here. So it just kept riding below the 8 and 21 EMA, then the 8 and 21 it crossed, it was up, consolidated, and then it just kept riding this 8 EMA all this time. You see the right? And if it breaks it, it bounces off the 21 EMA, it keeps going. And here it bounced right off the 21 EMA, kept going here. And then now here, finally, it closed underneath the 21 EMA. And that's bearish. It's very bearish. And now the 8 crosses underneath the 21 EMA is probably going to have a downtrend or consolidate. So I would not go long Apple here, especially this month. If you're thinking of going long, forget it. You're on the wrong side. I mean, this is for the entire market. Doesn't matter what sector, maybe energy, financials, some names may run. But this month, I promise you, until the Fed meeting is not over, do not go long. LB is going to touch upon these things. now when the interest rates of the market raises it, when the Fed raises it, usually the market does okay. I mean, it's a little bumpy, but once they start doing it after that, we get the results later, right? But for now, until the Fed, we're likely going to see some selling. When the tapering, everything kicks in, right, and the Fed accelerates, a market is going to see a little downshift. Maybe it consolidates, but long is not the time right now, in my opinion. All right. Okay. So just my 2 cents right there. And apart from that, guys, I think any questions you guys have on managing anything like that, please let me know. These are the sessions that we'll continue doing, throughout the year, obviously. And again, the more hard work you put in, the more you will succeed, the more you can get out of the markets, I think, right? And LB, I'm going to pass it on to you. Mike, do I use a stop loss on vertical or strangle? It depends. On strangle, yes, you can. Like INTC the other day, I was in Intel Strangles, right? I just stop out. Why? Because it went up the second day. It started consolidating here on a shorter time frame. And then here, maybe these strangles I think might pay me a lot, but I still stopped out near break even because I wanted that one directional move right away the second day. It did not really follow through. It got stuck in its consolidation. Time decay hit. So I said to myself, you know what, I'll wait. Another thing was volatility. VIX was going down. When VIX goes down, options usually sometimes get cheaper. So then that is not good for strangles. And when VIX is really high, you don't want to buy strangles because even though the market, you might get that one directional move because the options are priced so expensive, they might not even move that much, right? So for strangles, you have to be very careful when you're buying it. Harman, you can average down on strangles if you have time, but if you don't have time, don't average down, in my opinion. Why? Because both call and puts are just going to lose premium. It makes 0 sense to average down. Now, if you have a month, for example, right, and they're both down a little bit, right, there's still a hope for the move to happen, you can probably average down. But I would probably avoid, instead of averaging down the same money, I would throw it into closer strikes, in my opinion, and buy some more time. Makes sense? Because if the move happens, from that average amount that you put in, you will get your money, right? And then the others will also go up in value. Makes sense? So instead of the same strikes, I would go even closer strikes for average down. It's just now you're much more safer, right? You're buying more value now. Okay. And LB, go ahead. It's all yours now. I will stop my share and then you can share the screen from your side. And guys, LB is going to go over some important things as well for this year, something that you guys need to look out for, right? And so LB, you're on, brother.
Thanks, bro. What's going on? Let me know if you can see my screen here.
Yes, LB, we can see it. We can see.
All right, so I hate to sound really bearish and everything, but I just gotta go over a few things just in case it happens. So basically what's happening in the markets right now is there's a macro event going on. Like it's beyond technical analysis. So sometimes when these things happen, the charts don't add up as much, like they don't matter as much when there's macro news going. Yeah, I'll definitely go over NVIDIA. But what I wanted to go over here is if you guys actually need to understand what the Fed is talking about. So why am I holding only puts? Why all of a sudden everyone's bearish? What's going on, right? The first thing you need to realize is this whole rate hike thing. So if you guys don't know what interest rates are, I recommend you guys read up on them. Obviously, I just pulled up a little tiny thing here. We'll just go into like a little bit of the macro picture, what I'm seeing coming, what's possible in the market right now. So obviously you see this right here, when interest rates rise, you can read it yourself. I just get like everything gets more expensive basically. And when stuff gets more expensive, consumers still have to pay their bills become more expensive, less disposable income, meaning consumers will buy less and companies will make less money. So that's why the interest rate hike is so huge for the stock market. It's all a trickle down effect. It starts with raising rates and it trickles all the way down to the consumer spending less into businesses. So that's why they affect the stock market so much. And I highly suggest just reading up on it. Like this is, you guys make money from this. I know you can't just expect to wake up in the morning, start making money right away, right? You have to understand a little bit of the underlying stuff going on here. Another thing I mentioned in the chat was the balance sheet runoff. What do I mean by this? So basically they announced that they're tapering. Tapering means if they were buying, let's say $1 billion of stocks last month, they're buying 750 million this month, 500 next month. That's tapering off the buying. So in a way that obviously it's bearish, they're buying less stuff, but at the same time, it's just cutting what they're already buying. Balance sheet is a big deal. That's what they mentioned in the minutes on Wednesday. That's why we got such an exaggerated sell-off that day. Balance sheet runoff is basically, so when they buy all this stuff, even the Fed has a balance sheet, and that balance sheet is in the trillions of dollars. Once it gets too high, they have to keep it under control. They have to bring it down. How do they do that? They do a thing called a balance sheet runoff. What does that mean exactly? You just read right here. When the Fed begins to reduce its balance sheet, it will do so in one of two ways. It can either sell securities that it already has, or it cannot reinvest in securities that are expiring, which is a huge, huge deal, guys. When the Fed's like tapering is the Fed cutting down their spending, cutting down their buying. Balance sheet runoff is when they actually sell stuff, which is super, super bearish. So we're in the middle of a huge economic change, macro change in the markets right now, in the entire world as well. And the Fed is pretty much screwed whatever they do. Right now, they have to choose whether they let inflation run hot or they let the stock market run hot. It's one or the other. It cannot be both. So either they get inflation under control and the stock market comes down a lot, or they let inflation get out of control and the stock market keeps going up. So that's the macro event going on right now. I have a bunch of stuff out here. I was doing a lot of reading and research over this weekend, and a lot of similarities to this market are from the 2000.com bubble. I know I'm sounding very, very bearish, but it's just where the macro is telling me right now is there's no way for them to keep both inflation down and stock market up. There has to be one or the other. So basically what I'm seeing in the market right now, this is 2000, guys. So if you guys, you know how I said, eventually the buy the dip people, they will get annihilated. And I think that's coming now. Why do I think that? Just because this is the 2000.com bubble. If you guys go back and look at the history of it, it went up like, I think, let's just check it here. We'll check the QQQ here. Obviously, they made the QQQ, or the NASDAQ became a thing during the dot-com bubble. Like tech stocks were running from all the way in 1995. I'll show you a different chart to show you exactly what I mean. But right here, from August of 99 till March of 2000. So basically 6 months, 7 months, half a year, we had a run up of over 135% in an index on the NASDAQ. Then what did it do after that? It came down all the way from there to there. So it went negative 84% almost within the next 2 years or 3 years. So basically what I'm saying here is everyone knew internet was a thing. Everyone knew internet was going to be the big thing. So what happened? It parabolically shot up, and anything that parabolically shoots up comes down the same way. It's very volatile both ways. And one of the best examples I have for that is probably Bitcoin. So everyone knows, or I hope everyone thinks Bitcoin has a future. I don't know Bitcoin exactly, but Ethereum, blockchain, they definitely have a future, right? They have a use. There are so many companies in them, everything. And basically, I'm showing you if the internet, the dot-com bubble, the NASDAQ, the internet stocks, they can run up like this and they can get smoked all the way back down. Now, you tell me what is a bigger revelation, the internet or crypto? And it's done the exact same thing. It's the run up. And now when you pop a bubble, anything is possible. This thing can come down to whatever. It can keep running up to 100K as well. I don't want to tell you like it's coming down for sure. But when something goes parabolic, it usually pulls back just as hard. I remember one trade I took on Tilray. It was a short, actually. I almost caught the top on this one. Tilray used to be a $300 stock. Can you believe that? It's at $6 today. So look at this parabolic run up to $300 and it's never recovered, like not even close. If Tilray gets to $20 in the future, everyone will be happy. But this thing, it's just what I'm trying to say. People get excited, it goes parabolic, and then it can take years and years to fix that chart. So basically, one of the examples I wanted to show you here was, let me show you, where did I put them? Okay, so Qualcomm was around during the dot-com crash. And the thing I wanted to show you on Qualcomm, in 1995 is when the dot-com bubble started, actually. So everyone knew semiconductor chips are going in everything. This is the run-up from now, the beginning of 99 all the way to 2001, no, 2000, January of 2000. So everyone knew semiconductors are huge. Everyone knew it's like the future. It's tech is the best thing in the world. Internet's going to take over everything. And look at the run-up it went on here. And Qualcomm is one of the best companies in the world, guys. These guys, they have a lot of market share in their sector. And just take a look at this. Like this thing ran up from around 2,500%, guys, in about a year on Qualcomm. And what happened after that? It took years and years and years and years to get back to that high. So you guys see, let's just make this line up here. I don't know why I have that line. I don't even think I was trading back then. But $67 was the high, let's say. And look how many, this is from 2000, January of 2000. And it took Qualcomm, one of the best companies in the world, till 2019 to get back to that high. And this is one of the best companies in the world, guys. So imagine, compare that to Bitcoin, which has no physical value, no like, I mean, it's the slowest one of the cryptos on any exchange. Like, so you guys have to understand, even if you're the biggest believer in Bitcoin, the biggest believer in anything, for example, these things, when they parabolically run up, sometimes they come parabolically right back down, and it takes years and years for these to recover back to highs. So just keep that in the back of your head. Other than that, what did I want to go over? We can go over the SPX here. Like, look at this move from 2000, March of 2000 from the pandemic. SPX has gone up. Oh no, this is 2009. This is the financial crisis, guys. From the end of the financial crisis until today, until highs, was 622% on the SPX. After the pandemic low was at 21.91. We're trading at 48.18 was the high. So we well over doubled the SPX in less than a year. The average return on the SPX a year is 10%, and we've done over 100% on equity alone. So 10% a year is normal, and we've gone that much since the pandemic low, guys. So just keep all this stuff in mind. I'm not saying get mega bearish. I'm not saying sell all your equities. I'm saying make sure you have cash, make sure you're hedged, make sure you protect yourself. I mean, for a move in like basically a year and 6 months, we've gone 119% on the SPX, the biggest index. So keep that in mind, keep that in the back of your head. Go read up on the dot-com bubble. What similarities do I see from the dot-com bubble? It's exactly what I was saying. So basically, you guys seen all these stocks, like the market. If you just look at QQQ, oh, I need to add another Q there. If you just look at QQQ, there's absolutely nothing wrong with this chart. Like this is just straight up in a line. That's because it's been held up by names like Microsoft. It's been held up by names like Apple, like Google, right? These are the majority of the NASDAQ and SPY are in these names. So if these hold up, the indexes aren't going anywhere. The thing you have to realize is the underlying stocks, what's going on in other stocks. They're already cut, like SQ is from 289 and it's cut in half. It's less than half now, 140, right? SQ, you got Zoom. Look at this. It went to $588 and now we're trading at 171. These stocks are getting destroyed under the curtain. No one's even knowing, because all these the rich guys, the hedge funds, the presidents, all they care about is the index, and the index looks absolutely perfect. And I explained to you why. The big tech, that's where they have all their money. They have it in big tech, they have it in value, they have it in the indexes itself, SPY, dollar cost averaging. And as long as these go up, it's kind of masking what's actually happening under the radar. Exactly, like net Net was trading at a ridiculous multiple up here, $221 to 107, cut in half. Snow actually has more room to the downside, in my opinion, because it's still, I think, the most or one of the most overvalued plays right now. So a lot of these stocks, while they've come down a lot, there's no support here. There's no rush for me to start buying these long term. Like, do I know C Limited is going to be $1,000 stock in the future? I am like 90% certain. I know this company inside and out, and I'm very confident in this company, but there's no reason for me to be buying here. The monthly is under the 21-day. You can look at the weekly. It's not really any kind of support, any kind of reason why it would stop here. When they want to kill stocks, they can kill stocks. It doesn't matter. This SE can be $100 stock again, can be a $60 stock again. Just look at Lemonade, for example. People that bought up here at 188, now they have stock for 37 bucks. If they loved it at 188, why wouldn't they love it at $37? I'm sorry if anyone's holding, I don't mean it in a mean way. It's just these moves are insane. Look at LSPD. This was one of the strongest stocks before. It was at 130. I think Nils had equity, ran it up. I hope he sold because right now it's 36 bucks and it doesn't show any inclination of going up anymore. You know what I mean? UPST, exactly. Ginger knows what's going on. So under the curtain, under the radar, whatever you want to call it, stocks are getting destroyed. These great companies are getting smashed, and there's no reason to be buying yet, in my opinion. And right now, until January 25th, when we have a clear signal of what the Fed is going to do, I don't see bulls stepping in and buying a ton of stuff. It's just going to be continued selling, in my opinion. So what I did was, another thing I like, if we do go into the worst case scenario, if it starts looking like it already is looking like the .com bubble, but if we start going into these bad things, one thing I want you guys to focus on is dividend stocks. I gave you my dividend stocks. I have been adding there. Why? It's passive income every month with that dividend. Even if the stock goes down, it doesn't really matter to me. I'm holding them for the dividends, right? If it comes down, I add more. Those are forever kinds of holds. That's passive income monthly. I'm very comfortable holding that. And one thing that I think is due for a huge run is gold. I know people laugh at gold and it doesn't move, and Bitcoin goes 10,000 points in a week. Bitcoin goes 50,000 points in a month, and it's just more exciting. But for gold, I know it hasn't moved in a long time, guys, but when this stuff does hit the fan, if it hits the fan, people are going to run to gold. And gold is known for going on cycles. So the last time that we had a real inflation scare was 1980, I believe, under Jimmy Carter. Oh, this chart doesn't even go back that far. But it goes on cycles. So this is a bull cycle for gold right from the bat, right? And when it ran up, it's exactly what I was just telling you guys. Gold is not included in this. Gold went on a huge parabolic move, took years and years to form this cup back to new highs. And now we're working on a huge cup and handle here on the monthly chart. So one place I do want to be long-term is in gold. And the best way to play gold, in my opinion, is dividend stocks. So what I did was, it's very easy, guys. I just look up stuff, do some research. I mean, this is our career. This is our life. This is how we make money, right? So this is what I found on dividend stocks on gold. Obviously, it's a little outdated. So some of these dividend yield might be changed a bit. But I did add a few. I wanted to add some. Where to go? Where did I see this? Okay, yeah. So I was looking, obviously we're gonna go to the best one. Why would we look at the 10th best one, right? So one that I really like here is this NEM. I was looking at this, and I like this NEM. I like the 4% yield. And these kinds of companies, I'm throwing them in my dividend account. Again, it's just passive income monthly. I don't believe gold will go. I think gold will go up. As a matter of fact, when people get really scared of the market right now, there's no fear in the market. People are still saying buy the dip. People are still saying it's fine. We're trading like 2 or 3% off all-time highs, guys. So there's nothing wrong with the market. But usually when this kind of stuff happens, you either see it too late or you just get destroyed. Your accounts get destroyed. Okay, so basically what I want you to take from that is parabolic moves up equal a lot of volatility downside. When you guys think it can't come down anymore, it probably can come down some more. So just be careful buying randomly. Don't be buying just because it's lower. I mean, I have SE from $150 average from time ago. I did scale some out, obviously, but right now, if it goes back down to 150, will I buy? Unless there's a level or some kind of turnaround or some kind of support that holds, then I'll average back up. You know what I mean? But right now, I don't see a reason to add on to these stocks at all. If you have a 5-year base plan or whatever, even those, like, people are just so used to buying the dip, guys. Like, these people, like, it's just insane. Like, all these stocks are just, look at this Home Depot. That's a parabolic move that equals volatility to the downside. Look at Costco. Great companies, don't get me wrong, but when stocks make moves like this, they usually get volatile to the downside as well. So just be aware, protect yourselves. And a couple of ways I wanted to go over protection. Here's that NEM I was talking about. This is a great gold dividend stock. AUI is great as well. Yes, I seen that one. There was another one that was $10. It's called GFI. Yeah, I seen that Yamuna Gold as well. I was looking at that one. GFI is a great $10 stock if you have a smaller, or if you want to start a dividend account. It's only $10. It yields like 10, I think 3%-ish. Kirkland Gold, I've traded in and out of this one a bunch of times. So a lot of these, like, what, I don't see them going down much more. I see them going up, as a matter of fact. So what's better than getting dividends and your stock prices going up? .com bubble, I want you guys to read up on this a lot. It will, you guys will see some similarities that I seen. That's why I brought it up in the first place.